Hello, and good morning, or good afternoon, or good evening, depending on where you are in the world. So, what is going on in the world economy? We've heard warnings of a recession for a year, maybe more, but that stubborn economy just won't quit. Here in the US, we are darn close to full employment. Gasoline prices have stabilized, and you can get a replacement part for your refrigerator in less than a week. On the other hand, a meal in a restaurant will empty your wallet, and a lot of people looking to move are being squeezed by high rents and mortgage rates that put the homes they want out of their reach. In the UK and many other parts of the world, there are variations on that theme, with central bankers trying to control complicated economies with a blunt tool, and that's interest rates. And all in all, we seem to be settling into a pattern of what we might call stable uncertainty. Welcome to Global Sourcing Insights from SIPS. I'm Bob Rossback. Today we have two distinguished analysts who are going to give us their views on the big three issues facing procurement and supply chain managers: inflation, recession, and bottlenecks. Dr. John Glen is a visiting fellow at the Cranfield School of Management, Cheshire, England, UK. Dr. Glen is likely well known to many of you because he's a frequent expert contributor to SIPS, including regular commentary on the monthly UK manufacturing PMI reports released by S&P Global. His experience is global as well, and we are looking forward to that perspective. Welcome, John. Here in the U.S., I want to welcome Dr. Jason Miller, Associate Professor and Interim Department Chair in the Supply Chain Management Department of the Broad College of Business at Michigan State University. Miller's specialty is trucking and logistics, and he's a frequent commentator in the national media on supply chain issues. So welcome, Jason.
Thank you for having me, Bob.
Now, before we hear from Jason and John, I'd like to run a quick poll to get a sense of what's on your minds. It will help us shape the conversation. So, the first question of these three concerns: which one is causing you the most concern? Rising costs, that is to say, inflation, the threat of shrinking demand from an economic downturn, that is, recession, and sourcing key categories, services or goods, that is to say, bottlenecks. So which one of these three? You only get to choose one, and we'll take a second here to let you vote, and we'll take a look at the results. All right, is the poll open? I'm not seeing my results yet. Okay, so we are getting some responses here, and we'll have some results in a bit. About half of you have responded so far. All right, let's go ahead and close that poll. Take a look at the results. Okay. I am seeing here that rising cost inflation does look like it's beating out threat of a recession and sourcing. Sourcing is still that's a pretty high 25% are still saying that they're still receiving in bottlenecks. So that's pretty interesting. But rising costs, inflation still seems to be the number one choice here. So that's good to know. Actually, I'm going to open up the. Can we open up the mics? John Glenn and Jason Miller want to have a quick assessment of that. What do you think, John? Does that sound like what you are hearing around the around your offices and what you're around your sources?
Yeah, I would have thought that the threat of a downturn of recession might be a greater fear, but maybe that reflects, I don't know, if we've got more people from North America and the fact that the US economy is likely to grow. The fact that we're seeing 25% still seeing bottlenecks will align with some of the stuff that Jason's going to say, so that bottlenecks are improving, but there's still some problems. So that sort of resonates pretty well for me. In terms of question 2, I can't see all the responses. So
well, we'll get to question 2 here. So
yeah.
Jason, does this sound like what you would expect? Inflation still number one concern, or were you surprised that recession wasn't on the top of people's minds?
I thought it would be split between inflation and recession evenly. The 24% responding sourcing challenges actually does align very well with the Census Bureau data, so it certainly suggests the bottlenecks are not over yet. But I actually thought the recession piece would be higher than it was.
Okay. So now we're going to number 2, question number 2. Analysts have been predicting a recession for more than a year. How close are we? Choose just one. We're definitely at the beginning of a downturn. Still could go either way as signals are mixed. Likely to get by with a short and mild downturn or essentially none at all. So I am looking at the results there. And we have 57% are still think we don't know. So that whole uncertainty thing is still, we're certainly certain about that. So
Yeah,
John, does this
yeah.
does this meld align well with what you're going to tell us in a few minutes?
Yeah, I think so. Basically, we're at the point that if we avoid recession, we're going to avoid recession with insipid growth. So, less than trend rate of growth across all of the major economies in the world. I'm surprised that a third of people think that we're definitely at the beginning of a downturn. I would say we're definitely at the beginning of unspectacular growth.
Jason, does this align with what you're thinking and what you're looking at?
So I think the question of a downturn depends on whether we're talking downturn in your industry versus downturn for the overall economy.
Yeah.
Overall economic activity doesn't seem to have turned down yet, but especially in the industries that are likely represented here, we do have quite a few sectors that are down year over year, especially. And so that doesn't surprise me. If we think more, a local definition of a downturn of your firm's demand, I can certainly see where that is coming from. But it could go either way is, to me, where I'm kind of at as well.
Okay. All right. Well, then let's move on to the next phase of this, and that's Jason. If you could go ahead and take the stand here and give us an idea of what about those big 3: inflation, recession, and bottlenecks. We've got your first slide up here.
Yep. No, and how I would approach this is really, when you look at the U.S. inflation story right now, it really comes down to how you want to cut inflation. And so think about this as, beef that's being slaughtered. Do you like this cut? Do you like that cut? Depending on your flavor of how you like inflation, you may be looking at things good or things bad. So on the left, I've got my preferred measure of inflation, which is the Consumer Price Index, excluding shelter costs. And the reason I like to take shelter out of that picture is because we know that shelter prices in the United States lag by about a year. On that measure, year over year, as of March of this year, we're at 3.4%, which is decent, but within 2 months, we will be at that 2%, broad inflation target the Federal Reserve has. Part of that's because we're going to be going up against very difficult or very generous comps for April, May, June of last year. But if you take the shelter piece out, inflation in the United States is effectively back to the 2% target that the Fed wants to focus on. However, if we remove food and energy and put back in shelter to get core inflation, which is what I have shown on the right, then the story is a little different. And what we see is that we're at about 5.6% year over year. And while we've peaked, core inflation is remaining very persistent. We're not seeing that series come down sharply. That matters because as the Fed thinks about lowering interest rates, they're going to be focusing much more on the core inflation piece. And so when I look at this, what I'm seeing is a scenario where consumer buying power in the US is looking better now than it did this time last year when we were facing 10+% year over year inflation. However, yes, sorry, Bob.
Well, I was just going, so, I mean, we're really focused on the very, very right-hand side of these charts. I mean, we were looking at, if you look at going up back to 70s and 80s, you know, the inflation rate was huge. You know, we're like at half of that or less, you know. So this is when we think we're just not used to real inflation.
No, that's a good way of putting it. I mean, when we think about it, so much of the inflationary cycle that we went through in 2022 was really a function of food and energy, which is why we see the spike in that data is fairly comparable to the early 1970s, late 1970s, early 1980s. But on the core piece, we're nowhere near where we were in the 70s or 80s. We're actually a little bit above where we were in the late 1980s. Before we started to have easing of inflation due in part to globalization, keeping the price of goods low. And
Okay, so I have one more question here. Now, if I'm a consumer and I'm not looking for shelter, actually the situation isn't all that bad.
no,
However, and if I'm a procurement manager and I'm looking and all my suppliers are telling me, oh, well, inflation is horrible and that's why my prices are high, we should probably not believe them that much, you know, unless they're selling me housing.
So I would say there is, you know, probably the CPI wouldn't be the best cut to look at, but where I would say is, you know, that's where we have producer price indices for specific industries. And as will be coming up, where things are looking a little bit better on the industrial procurement side as well, which actually I think is a good transition as we move to the next set of data that I've got in front of us. And that is tied into this question about consumer buying power right now. And what gets a lot of attention is the data on the left, which is consumer credit card debt. This is from the Federal Reserve Board. And just to clarify what this means, this is like you pull your credit report and you have a credit card, you pay it off every month, but you've got some amount of debt on that credit report. This is that type of debt. So this doesn't mean that this is debt that people aren't paying off. This is just debt that shows up on credit reports. What we can see here is that overall debt has increased very sharply over the last year, but that is coming off of a very low base because folks had used stimulus money to pay down a lot of credit card debt or they were just buying in cash and not using their credit cards. What we've done is we've returned to the long-term pre-COVID trend line. So I get a little bit less excited about that because series reverting to the pre-COVID trend line is what we would expect given consumer behavior stabilizing. To me, the bigger question and what's shown in the plot on the right is what is the rate of credit card delinquencies? So in other words, what is the rate that folks are not paying their credit cards? What we're seeing right now is delinquency rates for all commercial banks actually are below pre-COVID levels, believe it or not. And so despite the strongest inflation in 40 years, despite the sharp increase in credit card debt, we're not seeing any signs yet on the consumer front that this debt is unsustainable. You know, this data looks nothing like it did in 2006, 7, and certainly 2008, 9, when we were in the worst of the global financial crisis. And so this helps explain why, for example, spending on services this summer and international travel is expected to be as robust as it is the consumer is not underwater as a lot of news stories have made things out to be. Which I think is a good time to transition then to our next bit of data, which is that producer inflation that you were mentioning, Bob. And in general, right now, this is actually looking very encouraging. So what I have on this plot is 3 different producer price indices. This is where the Bureau of Labor Statistics goes and surveys companies about the prices they're receiving from goods and services. The black line is the producer price index for what we call final demand finished goods. This is food that food manufacturers are making that's going to the supermarket. This is capital equipment coming from a Caterpillar that's about to be shipped off. This is machine tools and things like that about to go into a factory. We can see here that prices of final demand finished goods, that black line, they've risen 25% from before COVID. However, they're flat year over year. So we essentially have not seen those prices change for roughly 12 months. If we take a look at the red line, that measures the input prices for those final demand finished goods manufacturers, which the Bureau of Labor Statistics terms stage 4 firms. So this would be the input prices for an automaker. This is the price of cardboard packaging for a food manufacturer, et cetera. Those prices up again 25% from before COVID, but they're also flat year over year. And then lastly, the blue line shows the input prices for what the Bureau of Labor Statistics calls stage 3 goods producers. These are like tier 1 suppliers. So as an example, this would be the steel that is being used by a fabricated metal company making springs going into all-terrain vehicles, as an example. Those input prices for steel, plastic resins, and things like that, they're actually trending down right now. They're down about, on aggregate, about 12-13% from where they were at the peak of 2022. So we are actually starting to see some deflationary forces for inputs into those tier 1 suppliers. Now, that's not including labor costs. And so that's going to counterbalance things, which is very much why that red series, which you can think of as the outputs for those stage 3 producers, is effectively flat. So we have right now commodity prices coming down, wage rates going up, and those are essentially neutralizing each other to sort of create a neutral pricing environment from last year at this time, which is encouraging and certainly better than the situation we were in 12 months ago, where we were experiencing very rampant inflation on this front. But then that kind of sort of covers the inflationary piece. But as we start thinking, maybe the broader discussion about where the economy's at, that'll be showing up here in terms of overall activity on the next slide. This is where we get a little bit less encouraging. And this is why I was expecting actually a little bit more focus on in Q1 on, or the first poll question on, demand. On the left is housing activity, specifically single family housing. That is a tremendous driver of US economic activity, be it manufacturing, be it imports. What has happened in the last 12 months is we have seen a 30% decline in new single family housing starts. And with that has brought on a substantial decline in US manufacturing activity, US importing activity, as well as trucking activity. The good news is shown in this chart. While we fall in 30%, we seem to have stabilized around 2017 through 2019 levels, which were the highest levels we had been at since the global financial crisis. So it appears that the bleeding has stopped and essentially activity reverted to a mean where it was at before. But this is going to be one series. It's hard to see a bullish case until we start seeing interest rate cuts. No, that's the housing. Focusing on the US manufacturing sector, removing the 2 subcomponents that make things look too positive, which is pharmaceuticals and then computers and electronics due to measurement approaches. US manufacturing output has down about 1.5% from where it was last year at this time. And even with a robust rebound in 2021 and then the first quarter and I'd say first half of 2022, we still didn't get back to the average where we were at from 2017 through 2019, albeit with the caveat 2019 was a sharper manufacturing recession than where we are at today in comparison. And that shows up here by the fact, 2018 was a very good period. We saw about a 5% decrease though in 2019 in terms of manufacturing output.
So, so we're basically back to 2019 right now, but it's
Yep.
not really. But we're not at that 100. So and 100 is. Oh, that 2019 is your base year. Okay.
Yes. Yeah.
So
So
we're a
yeah.
little
So,
below that and hovering below it. So, so some of the robust. I mean, manufacturing was kind of keeping us going for a while, but you're saying that was primarily pharma and computers and electronics were probably driving that sort of false positive narrative that we were getting from manufacturing.
So what I would say, the reason I remove pharmaceuticals is from, let's say, a freight standpoint. Pharmaceuticals don't generate very much freight, but they receive a tremendous amount of weight, and because of what's called the value added of that industry. So pharmaceuticals have an incredible impact on GDP, but not the freight market. The computer and electronic product data is removed because how the Federal Reserve Board calculates it is it's actually calculating amount of computing power produced in the United States, not the amount of computers. And so we're making supercomputers today. Of course, these things have tremendous computing power. But again, from a overall economic activity standpoint, as we think about it as supply chain professionals, it overstates things. So this is kind of taking the very conservative case. And when we look at what's right now, what are the sectors that are down substantially from where they were in like 18 and 19 that are pulling down this data? Paper production is down tremendously. It's down about 15% from where it was in 2018. Aerospace production is down about 20% from where it was in 2018. So those two sectors alone have an impact. Wood products production has declined in the U.S. substantially since last year in the housing activity. Primary metal production is down about 5-6% from where it was last year at this time. And so you have a lot of sectors that are pulling down that activity. And so that's really sort of what's driving these dynamics.
Okay.
Yep. So as we continue here, talking about, for me, trucking activity is still probably the best measure of where things are at. And of course, I'm biased. I study the trucking industry. And what we have here is a ton-mile index that I produce with my colleague Yembo Imol at the University of Tennessee, where we essentially compute implied ton miles for the United States. That index on the left shows about a 2.2% decline year over year as of our most recent data, which is as of February. March's reading is actually going to be a little worse. I have a very good sense. So we're probably down 2 to 3% in terms of trucking activity, which is a very deep freight recession by historical sort of standards. The chart on the right is just showing our index tracks almost perfectly a quarterly index that the Census Bureau creates for trucking revenue when we scale our data up to represent revenue. So I have a very good sense that we're actually capturing what's going on. You can see that right now in the earnings calls that are taking place in the big public truckload carriers. Knight-Swift just yesterday had a major miss and pulled their guidance for the rest of the year, citing the fact that conditions were substantially weaker than they anticipated, which is very consistent with what this index has been suggesting for quite some time.
So I have a question here, Jason. So is this a forward-looking indicator? So I mean, this is one of those things where you're saying that a little change in these indexes means a big change in revenue and just so how the freight industry is viewing things. So they're in miserable shape right now. They're really whining.
Yeah, no. So, and this is it, is, freight volumes don't normally change that much. I mean, we had a 15% decline with the COVID lockdowns, and that's an incredible abnormality. Typically, freight recessions in the US, 2015, 2016 recession was down about 1 to 1.5% from 2014. That was very concentrated, though, in the industrial sector because we had hydraulic fracturing decline so much. We also had commodity prices bottom out. So you saw less construction equipment, less farm equipment, less primary metals, especially steel. So it was very industrial, heavy industry recession. 2019 was somewhat akin to that as well. The auto sector took a big hit with the strike in the fourth quarter at GM. What's weird right now is we're in more of I'm going to call it a housing related recession in terms of freight activity. So less large appliances, less wood products, less paper products. But the auto sector is doing very well at the moment. So that's sort of one of the shining beacons right now of US manufacturing. But then, not to take up too much time, sort of this last slide, which is going to, I think, resonate with folks who were reporting shortfalls in materials. I've been very aggressive in pushing back against the Federal Reserve Bank of New York's group saying that supply chains have returned to normal, because clearly they've not. The Census Bureau publishes data asking 7,500 plants each quarter what factors are affecting your capacity utilization. One of those check boxes is insufficient supply of materials. Roughly 25% of plants were citing insufficient supply of materials is affecting capacity utilization in Q4 of 2022, which is a shocking number that corresponds to this poll we've had today. Now, we have seen improvement in a lot of sectors. Paper, the issues have went away. Chemicals, food production, things are a lot better. But the three big sectors still having a lot of shortfalls are machinery, computers and electronic products, and then transportation equipment, right now, especially aerospace. And so what I would say is things are getting better in general, but we still have, especially for the three sectors of manufacturing that are still doing very well in the US, we still are having a lot of issues. And we can see that on earning calls with Caterpillar and John Deere as examples mentioning things. And speaking to folks at General Motors, they've certainly indicated that they wish it was 2018, 2019 when it came to material availability, but it is not yet.
Excellent.
And I guess the last thing to talk about, why are we not in a recession yet? Labor market's still incredibly tight. Quit rates are still elevated about 10 to 15% above where they were before COVID on the left. Quit rates are the most pro-cyclical labor measure imaginable. Once we start entering an actual recession, you will see quit rates drop very dramatically. They haven't done that yet. And the second is wage growth. And we can see.
Hold on. And quit rate is simply people who are leaving of their own volition to go do a different job or leaving the labor force.
Yep.
So this is voluntary quits.
Yep. This is purely voluntary quits.
Okay.
And we're still 10% above where we were in 2019.
People are leaving because they think they've got a better opportunity someplace else. So they feel they can afford to quit. Okay.
Yep.
Got it.
And then on the right, we have the wage growth tracker from the Atlanta Fed. So this is tracking essentially U.S. year-over-year wage growth from the current population survey. 3-month moving average as of March was at 6.4%. I've got the data goes back to the 90s. That's higher than it was in the late 1990s. And compared to before COVID, it was about 4%. So you're talking wage growth is 50% above where it was pre-COVID. That is not what you would expect if you had a labor market in a recession. And so what I keep telling folks is, yes, the tech sector, that is very likely a true recession going on. Tech is a small share of US employment, and that's why the labor market is still so tight.
So I should have been asking for a raise. Okay. All right. Are you all done then for right now then?
Yep, I
Excellent.
should be all done. So time to hand it off to John.
Yes. So just before you start here, just a second, I want to make sure that people know that they can ask questions using the Q&A function. And I really would encourage that because I'm sure we'll have some time for questions at the end of this session. So John, what do you make of all of this? Does it Does it gel with what you're seeing, or have you got a completely different point of view?
No, it gels almost perfectly. I mean, there are one or two slight differences that I will talk to. But again, let me start by looking at the outlook for the UK economy. This is a set of data that's produced on a monthly basis by the UK Treasury. It's 40 independent forecasting houses who present their forecast for the UK economy going forward. And as you can see, the expectation of growth in the UK economy is that we won't have any, the economy will slightly shrink into the end of this year. We won't have a technical recession, which is 2 consecutive quarters of negative growth, but the economy is going nowhere. In terms of inflation, our inflation has not come below 10%. The March figures were slightly disappointing. We're above expectations at 10.1%. But there is an expectation that the CPI measure, which is 10.1 at the moment, will decline significantly into the year, into the end of the year, and will be at 3.9%, which again, as Jason said, is well on the way to that 2% figure that the Bank of England and indeed the European Central Bank is charged with delivering. Okay. As far as unemployment is concerned, our unemployment is at 4.4%. That's technically full employment in the United Kingdom. So again, along with Jason, our labour markets are incredibly tight. And what we're actually seeing here is, significant increases in wages, very, very similar to the rates that Jason put forward for the US economy. But of course, because we have inflation at 10%, we're seeing real wage declining over the cycle here. So our labour markets are very tight. We are seeing increases in nominal wages, but falls in real wages. We're seeing the quitting behaviour that Jason has talked about. All of which is combining to drive, particularly the private sector, to increase wages, which are not being demanded by trade unions, quite interestingly. These are wage increases that are being driven by the need to retain and attract what labour is available. Okay, if we go to the next slide. Yeah, so now I'm repeating myself. I think, Bob, you in the introduction said that we're using this very, blunt instrument of increases in interest rates. So if inflation is so transitory and it's caused by cost push factors, which are going to sort themselves out, energy, food, fuel, then why are we increasing interest rates to such high levels? And we've got Joe Stiglitz, the Nobel laureate in North America, saying that both the Fed, the ECB and the Bank of England have overdone it on interest rates, and we've overcooked interest rate increases, and this is going to impact our real economy. And Andrew Bailey, who's actually the governor of the Bank of England, so is responsible, along with the Monetary Policy Committee, for increasing interest rates, has then said that 80% of the inflation that's occurring in the UK economy is beyond his control, which again beggars the question as to why interest rates have increased so much. But anyway, we move on. In the UK, we're obsessed by the fact that as far as the G7 is concerned, we are going to be the worst performing economy in 2023. But this is my point that I made in the introduction. Insofar as we are going to get growth, it's going to be pretty insipid around the world. The Russian growth is associated with going to war, okay, and the US economy growing at between 1% and 2% is way below trend rate of growth. For information, trend rate of growth in the United Kingdom is 2.25%. As I often say in these presentations, it doesn't matter whether you've got Margaret Thatcher or Trotsky running the UK economy, its trend rate of growth is 2.25% over the long run. And we found it very, very difficult to break out of that. Going on then, we can see that gas price inflation is working its way out of the system. This is the data from my friends at the Oxford Institute for Energy Studies, which shows the benchmark gas prices as of the start of this year are below, are back to where they were in 2022. And in fact, if anything, are heading south of that region. Okay, if we move on then to oil prices, again, we see the oil prices are declining from their peak. This is West Texas Intermediate. The same is true of the Brent measure of oil prices. There's some upside risk given what the Saudis have been doing recently, but again, unlikely to cause prices to rise to where they were. And so we'll see that working itself out of the data. And then finally, we have the data, if we move on to the food data, which shows that food price indices as of January of this year had declined back to where they were, if not below January 2022. We see the peaks into the early summer, May, June of last year, and then a return of food prices to some sort of semblance of normality. Okay, obviously a bit of pressure on cereal prices. If we can go back, to the previous slide, a bit of pressure on cereal prices, given the importance of the Ukraine there. And again, we're seeing government ministers in the UK starting to quote these figures, although they've come to them about 2 or 3 months too late. Okay, so the story that we're getting there is that the key drivers on the cost side of inflation are starting to work their way out of the system. And that's why you're going to see this dramatic decline in inflation throughout the year, okay, as the impact of that is felt in supply chains. The key issue here is that there may be some sluggish movement initially, which would explain the UK not coming below 10% in March, because obviously some procurement will have been done on forward markets at relatively high prices, and therefore we have to allow those contracts to lapse before we can start to see the true impact of lower prices working through into the supply chain. Okay, if we go on to the next issue then, so then I have an issue with this effect. So we're seeing food prices declining, and yet we see an increase in food and non-alcoholic beverages in the CPI, in the retail price measures of inflation. And the reason for this, if we move on to the next slide, is this concept. And I don't know whether, Jason, this is coming through in the US, but it's starting to get some traction in Europe and the United Kingdom. And this notion that it's what's called greedflation is driving core inflation. Okay, so what the European Central Bank and indeed Christine Lagarde at the IMF have commented on recently is the fact that typically when we see inflation, the first thing that economists look for is a wage price spiral. So they look at the labor market and the extent to which the labor market, and particularly unionized labor, are seeking to increase their wage rates so as to compensate them for inflation that has occurred, and if possible, to compensate them ahead of time for the expectations of inflation in the coming year. Okay, what the ECB and the IMF have actually been able to show is that if we start to look at inflation, particularly towards the end of last year, a key driver of that was increase in profitability and increase in profit margins. So essentially, the suggestion is that in an environment where prices are rising, ostensibly because of cost push reasons, that retailers are using this as an opportunity to increase their profit margins. And again, if you look at the average profit margin data in Europe and the United Kingdom, there is a statistically significant increase in those profit margins. So I put the reference there for anybody who wants to go away and have a look at it. Fabio Panetta, who's a ECB board member, covered this issue in detail in a speech that he gave in Frankfurt at the end of March. So we need to look at the extent to which increases in margins and increases in profitability are driving core inflation, as well as increases in wage payments. Okay, if we move on. So then finally, again, and this I think aligns pretty much with the stuff that Jason said for the PMI data in North America. We see staff shortages acting as a constraint on growth. So the whole labor market issue is a key thing that many organizations are going to face. And I think also, and how this comes out in the data will be interesting, it's not only the quantum of labor that's available in terms of people offering themselves for work, participation rates in the labor market, and the number of quits, which Jason showed being above pre-COVID levels, but it's also the nature of work and the way and patterns of work and the impact that that has on productivity. We see input price inflation fell to a 2-year low in March this year, again starting to reflect some of the patterns that Jason was picking up, but with a way to go. Delivery times are shortening, which shows that despite the constraints that Jason has illustrated, which are real and align perfectly with our poll. Well done there, Jason. And I mean, we couldn't have got that any better if we planned it. Okay, delivery times are shortening, again, to the greatest extent since April 2009. So we're seeing some fluidity in supply chains. Confidence, I would say, consumer confidence and business confidence, I would say, is pretty fragile. Okay, it's kind of highly correlated with where GDP is going, and as we've seen from our poll, we're not very sure where GDP is going. And again, in the United Kingdom, we're definitely seeing a two-speed economy with services expanding and manufacturing really struggling. Indeed, in almost a mirror image of, a perfect image, perfectly correlated image to what Jason talked about. And we've got construction caught in the middle. Okay, so I think the patterns that Jason is seeing in residential construction are starting to emerge. We had residential construction booming into the end of last year and now starting to contract quite significantly. We're seeing some worrying data around particularly our SME construction companies with increased companies going bust. Yeah, there's a pattern that's starting to emerge there as far as construction is concerned. And of course, I'm assuming the same is true in North America. Construction is always generally as a sector held up to a certain extent by big civil projects, which are hard to sort of stop or decline very, very quickly. Okay, so that's where we are as far as the PMI data is concerned. Pretty much a mirror image of what's going on in North America. If I were to say the key differences, well, as the figures showed earlier, the North American economy is probably growing a little faster than we are in Europe and definitely in the United Kingdom. I think that's good as far as confidence is concerned, and you saw that in Jason's consumer data. I would say that the consumer is not as confident in Europe as they are in North America. But then I think we're probably 6 to 9 months behind the cycle of North America and Europe.
Okay.
So I'm going to leave it at that, Bob, and we
Yeah.
can take some questions.
A lot there. Absolutely. Yes. Let's circle back to a question that John had that Jason answered in the Q&A, but just to clarify here, the question was about quitting behavior and whether this is and is it from retirement or changing roles, or is there any way to drill down a little bit more into that? And Jason, you had a suggestion?
Yeah, so with this data comes from the job opening and labor turnover survey, the JOLTS data. It just is asking firms what percentage of, essentially how many voluntary quits did you have last month, so we don't know why. JOLTS does separate, so quits themselves are quits that are not people going into retirement. So this is voluntarily, I'm leaving you, I'm not going into retirement. However, if we wanted to take a different cut at the data, we can look at labor force participation rates for folks who are older, so 55 plus or 55 to 64. In both sets of data, we do not see any type of recent spike or actually recent drop in labor force participation that would correspond to these quits in 2021, 2022 being retirement. Because if that was the case, we would expect that we'd be seeing drops in labor force participation. So it doesn't seem to be the case. It's people finding different jobs.
Okay. And it looks like the number is if you're over 55, and I'm one of those people. I'm not going into retirement early. Now that I can work from home, I don't have to commute. Heck, I'm just going to keep working.
Yeah.
Okay.
Yeah, I think the only difference in, and I think I might have said this in the previous webinar, is in the United Kingdom, and I think this aligned with what Jason said, that in COVID, or as we came out of COVID, there was definitely increased quitting in that 55 and above. And there was an argument that they were quitting into retirement, a significant number of them, because it was the end of what we call the defined benefits pension schemes in the United Kingdom. So you had people who were on incredibly generous pension terms who were actually saying, yeah, time to take this and go. Okay. Now, whether they then come back into the labor force is an interesting thing, Jason, and there is some evidence that that's happening as well.
Excellent. So let's move on to let's circle back to a little bit about greedflation, which progressives might also call gouging. And Jason, you had a note on that there is some consistency in the data here that at least in food that there is some taking advantage of inflation to increase profit margin. So talk a little bit about that.
Yeah, and so I think the big thing we have to make a distinction here is the idea of profit per unit sale versus your rate of profit per unit sale, right? And so what happens is in retail is, let's say something used to cost me $1 and I sold it for $1.50. So my gross margin rate's what, 50? It's 33%, right? Now let's say that thing has doubled in cost and it cost me $2. Well, I can't raise my price 50%. I've got to raise my price the same, or I shouldn't say I can't raise my price the same amount or that I'm getting charged. I have to raise it even more. And so what we're running into right now is the fact that as milk becomes more expensive, not only do I pass on that higher cost to you in the form of higher price, I have to also add a little bit more to make sure that my margin rate is the same. And so that's what we're picking up, that as we've had grocery stores experience higher costs for food, they're not only passing the cost on to the consumer, they're adding the additional that they need to keep their markups to where they were. If there was one sector in the US where we were seeing as close to gouging behavior as you could get, it was used cars in 2021. And you can see that in terms of how dealer profit margins have average profit per sales have plunged over the last year. And so that's where I would say if there was one sector where we were having that, it was there. But here's the challenge from we want to regulate this standpoint. This isn't due to industry market power. Automobile selling is one of the least industry concentrated sectors of the economy. It was too many dollars chasing too few goods. And so that's the challenge is it a crime if there's a lot of demand and not much supply to charge a higher price? That's just basic economics.
Yeah. Yeah, it seems like the oil companies went through a period of that when the prices spiked. It looked to me like they were increasing not only their prices, but they were sneaking up their margins at the same time for a little while. So it wasn't just the rate. I mean, it was the rate that they were actually getting a higher margin. Now, of course, they're in an incredibly weird market because of the number of players and the high cost of exploration and all that. So maybe we could excuse them for doing that. But it did seem like they were using a little bit of greed inflation in their pricing strategies for a while. Yeah,
the key thing there, though, Bob, is that Panatta at the ECB, if you read his, the transcript of his presentation, does exactly what Jason would expect him to do, which is to say at the end of the speech, if you don't stop this, the penalty is higher interest rates. Okay, because we got to drive that driver of core inflation out. Essentially, too much money chasing too few goods. And they do make the point that it's not exploitation of a strong monopoly position. It's happening in many industries where it's just basic demand and supply conditions.
Yes. Well, and it does seem like markets responded to the cutback in oil production by the Saudis with a big yawn. I mean, that didn't change prices substantially.
It's not the summer yet, and we haven't hit the Russian price cap. That is the inflation wild card right now, is the Russian price cap getting breached this summer at the $60 a barrel. And do we see the Russians cut oil production in response? If that happens, all bets are off.
Okay. So it could be a difficult summer at the pump still.
It could be. And I mean, the thing that Americans have to realize is we lost 5% of our oil refining capacity when COVID hit. A lot of inefficient plants that were just surviving on the margin closed down. They're gone. They're not getting fired back up. And so where I look at a lot of industries, we have high rates of capacity utilization because they're capital intensive. And there's really not much ability to quickly increase production in response to demand. That's why lumber prices exploded when there's all this demand for lumber in 2020, 2021. That's why price of oil explodes. Commodity price goes up. We were exporting so much. We still are exporting so much refined product right now to Europe. We've had a complete change of the global trade lanes in that petroleum and product sector because of the Russian sanctions. And so that's where the uncertainty comes from right now. I tend to be very skeptical of these market power arguments, especially anytime you're getting into something that's a commodity effectively, because there's you get a lot of speculators in there too. There was no reason that wheat was $13 a bushel in May of 2022. That was just speculators in the market. And once the fundamentals weren't there, the price plunged.
Okay. So we have two questions that, Jason, you've answered in the chat stream, but I'd like to just touch base on them. How does the U.S. small business market look? Is that stable, or if you're a small business person, what is the outlook there?
So obviously it is challenging right now. We know from the Atlanta Fed's surveys about uncertainty, revenue uncertainty is still incredibly high right now from before COVID. But we do know that the number of requests for earned income numbers, so EIN numbers that you need from the IRS to start a business, they're 50% higher right now still than before COVID. People are wanting to, start new companies right now at a rate we've not seen since the 70s, effectively. So we're actually in like a golden age of entrepreneurship right now in the United States, even though it's challenging given all the uncertainty, given a lot of the regulations. So
Okay. So wait and see. So we have another question here about services. Now, you talked a lot about inputs on the producer side and on manufacturing, but is there anything that's comparable in the service industry? What is the outlook for people who are buying indirect and in particular services?
yeah,
Is there advice for them?
So if you're whatever service you're buying is go to the Bureau of Labor Statistics Producer Price Program. You can do searches within commodities or within industries. So just type in what it is you're buying and see if there's a PPI for it. There usually is. For example, since I'm mostly focusing on trucking, I'm all the time following the producer price indices for truck transportation, and there's various ones, truckload, less than truckload, et cetera. So we do have very good data on that. In terms of industry output, it's not as clear. The best way to do that is find the industry, look it up in the current employment statistics data, and see if their employment's changing. Just assume more employees means more output, less employees, less output.
Okay. All right, we'll send them there. So, John, we've got a couple of minutes here. Do you have a minute or two for a closing comment?
Yeah, I would just say that the sort of feel here on this side of the pond, as it were, is that we're in for a bumpy ride as far as demand is concerned into 2023. It's not that we're going to go into recession. We've just got to see 2023 out. There's an expectation that inflation is going to abate. There are issues for organizations looking at the quantum, quality, and nature of work and making sure that they've got the right number of employees in. So there is definitely going to be a significant war for talent, and attracting that talent is going to be expensive. The extent to which we develop our own talent is a key issue. We have big issues in the United Kingdom in terms of training. We introduced an apprenticeship levy 3 or 4 years ago, and most of it is unspent. So it's been viewed as a tax rather than something that people draw down upon. So I think ride out 2023, the sunlit uplands in 24, maybe not, but things are going to be better. Inflation will have gone out of the system, okay, but then we just have to hope that there are no black swans. And I think I talked about, in the presentation last November, the black swan that we're really worried about in the United Kingdom is cyber attacks and the impact that could have on our supply chains and the economy generally.
Okay, a lot to think about. Jason, would you agree? What's your final assessment here?
2023 is going to be, I think, a rough year economically, just the uncertainty. We're not going to see much increase in freight volumes. Retailers are cautious. We're not sure where consumer spending is going and where consumer behavior is going. 2024, let's say we start getting interest rate cuts, which I would expect probably by the end of Q1 24, maybe early Q2. That'll be a nice boost. Reshoring is going to be a positive, but I think the benefits are being overstated, especially employment-wise, for a simple reason. Back in, let's say, 2012, the U.S. imported maybe 10,000, 12,000 industrial robots a year. We're now importing 100,000 a year plus. So we are definitely capital deepening, and we're not going to see that labor rebound, even if manufacturing increases. There's some major bullish reasons for the U.S. economy. The ag space is doing great. Renewable diesel is going to be an incredible boost to farmers. It'll be a boost to the railroads. I think for me, the biggest concern is the return to basically Cold War era economic blocks. And while I don't think we're going to go that far, that is a concern. And obviously, I'd say other than a massive cyber attack, my big black swan is Ukraine goes nuclear, at which point all bets are off.
Right. Yeah.
Yeah.
Well, sobering thought to end with, but that's where we are. That is the world that we're living in. And thank you both very much for this, John and Jason. And I hope we can get together again in another 6 months and take a look back at 2023 and look forward to 2024, hoping there is some of that. I'm sure there'll be plenty to talk about then. So in the meantime, thank you very much again, and thanks everybody for participating. I'm Bob Rosbeck. This has been Global Sourcing Insights from SIPS. Have a great day.